Section 4 covers securities, borrowing and lending. Now this involves exchange participants, securities dealers, borrowing from securities from a client and then lending them to another client. And often the lending is to enable covered short selling. So Section 4 covers some of the arrangements, types of risk, etc. The points that I would like to focus on are in Section 4.2.2, the stock exchange rules. And it tells us that an exchange participant that is engaged in stock borrowing lending must collect collateral of at least 100% the value of securities loaned. Okay, but if you are lending to enable short selling, you must collect 105% of the value of securities loaned. And you must mark to market all securities borrowings at least daily against previous day's closing price. Those points I've seen come up in the exam. Be aware of the other material, but not regularly examined. Now, regulated activity that can pop up because it's one of the 4 regulated activities covered in paper 2 is advising on securities. And there are many licensed in Hong Kong for advising on securities. And the definition is reasonably straightforward. It tells us, as defined in the SFO, advising is the giving of advice, no surprises there, and the issuing of analyses or reports to allow recipients to make decisions on the buying or selling of securities. So immediately all stock analysts are covered by this activity. Those that are exempt from requiring the Type 4 license, we've seen this pop up in earlier material. Solicitors, counsel, professional accountants, trust companies, and Type 9 licensees, that's the fund managers, who give advice, and the wording is so important, wholly incidental to their professions. So their major focus is in the law or accounting, and the fact that they're giving securities advice is wholly incidental to their profession. They do not need a Type 4 license. Please be aware of that. Secondly, financial journalists and broadcasters who give investment advice or issue analyses reports to the public on subscription or otherwise. So it's surprising for some people that financial journalists and broadcasters who have such an influence on the market, they do not need to be licensed for Type 4. Thirdly, corporations giving advice, issuing analyses and reports to wholly owned subsidiaries. Now, that is in bold. It's not partly owned subsidiaries, wholly owned subsidiaries. They're exempt. And Type 1, Type 2 licensees, so that's securities and futures, giving advice wholly incidental to their dealing activities. They're principally dealers. The fact that they give some advice, they won't be being paid separately for that advice. And then right at the bottom of page 14, we're told that corporate finance advisors and asset managers require separate Type 6 and Type 9 licenses. So Type 4 will not do. Now, for advisors, there are conduct requirements, and these come from the Code of Conduct, and they've been separated here. Please read through them. A lot of detail. That detail, all that detail is not going to appear in the exam. It may be of interest to you if you are a stock analyst and what your conduct requirements are expected to be. Moving on to Section 6, online trading and advising. Now we start to get to a lot of material where the hit rate in terms of questions is low. So I'm going to suggest that you read through this material without getting too alarmed. 6.4 there, the conduct requirements of electronic trading in the Code of Conduct. And there it is. We have quite a few pages. Now this was really driven by Flash Boys, the book by Michael Lewis, which exposed all the computer algorithmic trading that led to flash crashes, etc. And a number of regulators responded accordingly, Hong Kong included. Section 6.6, advertisements on the internet. Yes, I would read through that and be aware of what they're saying. Possibility every now and then of a question popping up. Now, I want to spend a bit of time on the next two sections: alternative liquidity pools and automated trading services. Alternative liquidity pools are private platforms providing liquidity for listed securities. The one thing they do not provide, unlike the official exchanges, is transparency. So you don't get much information, but you would approach these pools to see if you're wanting to buy, if they have securities for sale, and if you're wanting to sell, whether there are buyers. 7.1, management and supervision. This has been examined, so let me go through the points. We're told an alternative liquidity pool operator should have written policies and procedures to ensure that there is at least one responsible executive officer responsible for overall ALP management and supervision. Now, this can be confusing because we know that for every regulated activity you operate, you must have at least two responsible officers. Well, here, with regard to the management supervision of the ALPs, you must have at least one responsible for the overall management supervision. There should be controls to manage the risks of the operations. There should be formal governance process with input from risk and compliance functions, and there are clearly defined reporting lines. One thing to pick up there are 4 bullet points, easily suited for a multiple choice question. And then regarding access to an operation of these pools, an ALP operator should ensure only qualified investors can become ALP users. Ensure client orders have priority over proprietary orders, and revise, update as necessary the ALP guidelines. I want to go back to that earlier point there, the priority over proprietary orders. What this implies, which is correct, is that proprietary orders are permitted. That is, the ALP operator can buy and sell through the alternative liquidity pool. And don't be confused if they put in a question that proprietary orders are not permitted. They are permitted. The point is that client orders have priority over proprietary orders, which is the same with securities dealing in the Code of Conduct. The adequacy of systems, ALP system should restrict visibility of trading information available to staff of the ALP operator. So be aware of that, unlike your normal exchange operating systems. As I said, there's lack of transparency, including restricting staff access to the trading information, keeping the SFC informed of the identities of staff with access to the ALP, maintaining a log with details of staff access to the ALP, ensuring that staff members who originate proprietary orders in the ALP do not have access to the trading transaction information. So I've really highlighted and pulled out a few points under alternative liquidity pools, and that is justified by the type of questions we have been seeing. It's only one page, so I would be comfortable with that. Now, Section 8 on automated trading services, this is type 7 regulated activity, doesn't come up as much in the exam. However, it is one of the 4 regulated activities covered by this exam. What is an automated trading service? Well, there are 2 types. One type is an in-house proprietary trading system, and that is what needs the type 7 license. The other is, and I'm looking at the second bullet point, the 3 sub-bullet points. The second sub-bullet, full trading and settlement systems, bulletin boards with information on stock and other related matters. Now that second one has got the number sign, and if we go to it just below, it says part 3. This is the part of the ordinance. A person may be authorized to provide ATS similar to the service provided by a recognized exchange or clearinghouse for Hong Kong residents. Now, this is an exchange-like platform. It's included in the definition of automated trading services, but it does not need to be licensed. It must be authorized by the SFC. No, the one that we would focus in on is the first one under the second bullet point. That's trade confirmation matching systems provided by brokers. That is your in-house proprietary trading system. And you required to be licensed under Part 5 of the Ordinance, that's a little bit further down, to operate such a service. And then we follow with the core standards for such services from 1 to 9. Okay, I'm going to now really skim over a lot of this material because it may come up, it may not. It's not core material, but there's a lot of it. Section 9, offers of securities, covering type 1 and type 4 activities. There's two types of offers, as I said earlier. The first is listing on the stock market, and that second sub-bullet point at the top of page 23, prospectus requirements of the QMPO as part of an offer of securities. QMPO, well, it's highlighted there, section 9.1, offers of listed securities requirements of companies, winding up and miscellaneous provisions ordinance. That is where prospectus requirements in the legislation appears. And you have to follow that if you are listing securities, which is a way of offering securities to the market in Hong Kong. And the second is the offer and distribution of shares, units and other interests in collective investment schemes and structured products covered under the SFO. So this QMPO regulates the prospectus which is put out to offer securities as a listing, whereas it's the Securities and Futures Ordinance you have to follow when you are distributing collective investment schemes. That said, the details for the listing and the prospectus requirements appears under section 9.1, and under section 9.2 we have the SFO requirements for collective investment scheme offering. And I'll leave you to read through that in detail. As I said, there's a lot of it. Section 9.3 on structured products. Structured products were very, very common in Hong Kong up to and including 2008. But that's when everything went horribly wrong, and structured products are not as common as they were, and that is reflected in the lack of questions that appear in paper 2 on structured products. Cross-border trading, Shanghai, Hong Kong Stock Connect, the Shanghai, I beg your pardon, the Shenzhen Hong Kong Stock Connect, introduced 2014, 2016 respectively, and there is a lot of material on that. If it's examined, it will be 1 at the outset, 2 questions. Be aware that there's only certain eligible securities that can be traded through these stock connects. You have the northbound from Hong Kong to Shanghai and Shenzhen. You have the southbound from Shanghai and Shenzhen to Hong Kong. They are a way of opening up the China markets to international investors, but it is not totally open. There are restrictions, and you can see the trade quota restrictions under 10.3, section 10.3, the northbound trading link quota being 52 billion renminbi, and the southbound trading link being 42 billion. The daily quotas are calculated on net buy basis. That is, it is that quota of purchases during the day less the sales. So you have a net buy basis. Be aware of that. Trading, clearing and settlement, lots of detail there. I draw your attention to the last bullet point on page 31. Southbound trades are settled on a T+2 basis. Now, we covered that in topic 4. That is the Hong Kong norm. You trade in day T, you settle in T+2. But with Shanghai and Shenzhen, the northbound trades settled on the same day for securities, same day settlement for securities, T+1 for money. Now, that settlement on day T causes problems because you've got to have the securities available when you make the decision to sell, and they must be with your selling brokers. Well, that is covered by section 10.5, 10.5.1 and 10.5.2. Read through the standard pre-trade check and the enhanced pre-trade check, because that has appeared in questions, and then do the practice questions that cover those points. There are additional restrictions on northbound trading for margin trading, stock borrowing and lending, and short selling. Be aware of those. The last section in topic 5 is covering virtual assets, which is relatively recent. Now, what I'm going to highlight is one or 2 points. Under section 11.1, the last bullet point, the SFCs define digital tokens as virtual assets, irrespective of how they are referred: cryptocurrency, crypto asset, bitcoins, etc., etc. Here's the major point, and this is in section 11.2, and it's the Hong Kong regulatory regime, where a virtual asset in substance amounts to a security or futures contract as defined in the SFO. Usual laws and regulations will apply. Whatever this virtual asset is, if it is in substance a security or a futures contract, then the SFC laws and regulations apply. However, second point, where a virtual asset does not fall within the SFO definitions of securities or futures contract, the SFO will not apply. And that addresses the sort of confusion as to whether or not these new virtual assets were subject to the same rules and regulations of securities and futures industry. And that really answers that point. And then you have more detail in sections 11.3 through to 11.6. Now that's not yet been examined, but I'm sure questions will start popping up. As ever, the best way to address these and to get it into your short-term memory is to do the practice questions on Examinator.online. There are practice questions covering virtual assets, and I recommend that you go there to help with filling your short-term memory.